If you like to trade 0 DTE options on the SPX, and you're usually buying calls and puts and trying to get that move to go with you in the same direction, I'm going to show you another way to do these where the theta decay that usually will chew up your call or your put works in your favor instead of against you. Most of you know what theta decay is. It's the time decay in an option as it expires. And on a 0 DTE option, that expiration date is rapidly approaching as the end of the trading day. So the decay in your options when you're buying calls and puts ramps up really fast and starts to decay your profit potential in those calls and puts. I'm going to teach you how to flip that on its head and sell the option so that theta decay works in your favor. And the way I'm going to show you how to do that is by trying to find a pin. What I mean by a pin is where the SPX is going to close for the day, and using a strategy called a butterfly, whether you do a standard butterfly or you do an iron butterfly, to guess where that pin is going to be and place a risk reward trade that, depending on where you are in the SPX, will give you a very outsized risk to reward, where you could be risking $100 to make $900, $50 to make $450. They're not as regularly profitable in terms of they don't hit as often. There's about a 40% win rate on these, and they're what we call lotto style plays, which means the amount that we're putting into that trade, the amount we're putting at risk, we're perfectly comfortable losing that entire amount if it does not go where it's supposed to go. And if it doesn't go where it's supposed to go, that's a max loss, which in this case is very small. But on the rare occasion that we do hit these, the profit factor is way up. We're making, $300, $400, $600, $700 to our $50 or our $100. So in this video, I'm going to teach you how to do that. And then I'm also going to teach you how to use gamma exposure to find those levels and increase the potential that your pin that you've picked is where the market is going to close on the day. It's not exact, but it definitely helps in finding where those areas are. All right, let's get into the video. So today I thought I would come on and do a lesson on the pin trade using end of day pin trade on the SPX, and kind of how we do that and how we set up those trades. So for me, I like to use the gamma exposure levels, most specifically the absolute gamma level, for a pin area when we're looking at possibly trying to get an iron butterfly or a regular butterfly pin at the end of the day, using theta to our advantage, right? And for those of you who know what theta is the decay, the time decay in an option contract. And the reason we do that I just got taken out at 25% on this SPY bounce. So I threw that on just before we got on the mic and had the OCO order in, and it just took me out at 25. There might be more in there. However, we kind of look at this sort of downtrend that we're in, maybe not a lot more, but this was gap close from 2 days ago. So that was a nice quick trade off of that. The idea behind the pin trade at the end of the day is we're using 0 DTE options. We are picking a strike price where we think the market will close thereabouts, and we're using gamma exposure to do that. And what we're putting on is either a standard butterfly, where you're buying and selling 4 calls or puts depending, and then an iron butterfly, which I prefer a little bit more. I don't know why I prefer it more. But you're buying a put credit spread and a call credit spread, and you're selling the exact same strike. So we'll get into that here in a second. But I use the absolute gamma levels to give me a decent idea of where the market has to come back to. And the reason for that is this absolute gamma level. This is not the level that I would do it on today. I usually like to wait until the gamma levels update at 1:30 Eastern, and then I want to see what was it at market open, right? So 7,400, and then at that 1:30 time frame, where is it now? And is it staying here, right? Let's say at 130, the absolute gamma comes in and it's also at 7,400. That tells me that this is a pretty large level, and there's a pretty good chance it's going to act as a magnet. Based on today's price action, though, I think the absolute gamma level is going to shift. I think it's probably going to shift down into this area just because we've kind of had a sell-off across the market. 7,400 has been a big level for a while, but I really think that's probably going to shift at least for today's expiration. And if it does shift, then what I want to look at is, where is that in relation to sort of VWAP and where price action has come. And then sometimes I might look at open interest as well, which is not open on this gamma exposure setting at the moment, but at the 130, I'll usually add the open interest, and you can turn that on just by going in and saying, okay, I want to see what the open interest magnet is, and you can turn that on and it'll pop in if there is one for that day that stands out. So to kind of explain what absolute gamma is these gamma exposure levels, if you've done trainings with me before on this, these gamma exposure levels are large areas of basically open interest at, the largest call volume level at that strike, the largest put level, and then the absolute gamma is the largest level overall, combining both calls and puts, right? So that's where the most activity is. So you can think of, if you understand volume profile, right, you can think of call resistance here as your value area high, and put support as your value area low, and absolute gamma as your point of control, right? This has the largest amount of gamma exposure of all the strikes in that particular expiration date, right? So we're using 0 DTE options. That has the most. So as market makers are hedging, right, they are trying to get back to delta neutral, and they're using gamma to do that. So that level should act as sort of magnet. Now, if we get into the end of the day and there's some volatility in the end of the day, that absolute gamma level and that magnet can kind of move around based on, if it's being hit, market makers are hedging, a new level is forming. But if we're kind of closing and there doesn't seem to be a whole lot of volatility into that close, it usually will hold, and we can kind of close near that level. We all kind of experience, we talk about in the room a lot, the max pain level. So this level down here right now is 73.70. It's the put support level and the max pain for today. Generally, the max pain, surprisingly, really doesn't factor into the close. If we happen to be around that area, and it's an easy place to move the price into, market makers will do that. But it doesn't seem, in my experience, now that I've been trading with gamma exposure for, maybe a year or so, year and a half, it doesn't seem to be as strong an indicator of where we might close than we usually would look it up on FinViz and say, okay, what's the max pain? Let's get a butterfly for that. The absolute gamma level seems to be the one that is a little bit more accurate in that sense. So what happens is we get into the 130 time frame, the new gamma levels post here, and I look at where we are on the absolute gamma, where we were for the beginning of the day. And then sometimes I look back and say, okay, it has 70, let's say it's 7,400 again. Let's say we start working our way back up in here, and at about 130 we're trading, we've come up, we've pierced the VWAP, we've come back down and retested put support and VWAP, and we're just kind of in here at 73.76. If the absolute gamma level is still 7,400, there's a good chance we might be working our way back up to that. And so that would be valid. If that moves down here, also pretty valid. But what I'm looking to do is usually take that level or a level kind of slightly right around it, like the strike above, like 74.05, or the strike below at 73.95, and take a butterfly trade on that. Now, a butterfly trade, if you're doing a standard call butterfly, let's say we're doing the 7,400, you are selling two calls at 7,400, and depending on how wide you want your wings, you could go a 10 wide. And so then you're buying a 7405 and you're buying a 7395, right? So this is your selling 2 and you're buying 1 on either side. Okay. And those are all calls. Okay. All of those are calls. And you're hoping that you come inside the wings before the close, right? So you're wanting the 2 contracts that you sold to go to 0, but you need to be inside the wings. And the reason I draw that, so I'll give us a little bit more space here so we can kind of talk about that. So if 7,400 here is the strike that you're trying to pin at, and it never pins exactly at 7,400, and then you have a 10 wide wings, I draw it like that because the profit profile is kind of like this, right? And so if I zoom into that even tighter, a butterfly ends up looking, like an arrow. So you get, if you pin exactly at 7,400, let's say, on a 5 wide, you're gonna make, well, you gotta, whatever your price is, but you're gonna make $500, minus whatever you paid to get into it. And then if you pin somewhere around, where 74.95, if you pin somewhere in the middle of this range, that profit drops off. So perfect pin would be 500 minus whatever you per contract, minus whatever you paid to get into it. And then it's descending down here, to about, this is, anything below this is max loss. Anything above that is max loss. And then, maybe here's a $250 win. Maybe here is, $100 win, and your break even comes just before your strike, a little bit before your strike, and then outside that is max loss. But the difference here is, especially if you buy these on a regular butterfly, if you buy these way down here where we're at right now, this thing's going to cost you, 20 cents. So $20 per contract, to make, 480, right? So the risk profile is crazy. And if you pin exactly, your total reward is massively outweighs, what it costs to get into that trade, but your probability is really low. And so we call these a lotto style trade, right? Which means if I'm going to put on a butterfly for 7,400, now granted, this is not a trade I'm doing right now because I'm waiting to see what the absolute gamma level is at 130. But I'm just sort of mapping this out for you so you can see it. So at 7,400, I'm going to go to my option chain. I'm going to go to the 7,400 strike. Hold on, I got to open some more for today. And if I were to buy a butterfly, let's see what that looks like. And I wanted it to be 5 wide. It's going to cost me roughly 5 cents. I'd probably have to go to 10 cents to get it to fill. It's going to cost me, 5 cents to fill, which is, $50, because every option contract is you're controlling 100 shares, right? And the risk profile for that is, let's say it was 10, right? So you're going 5 on either side. So it's going to cost me to put on a 7,400, 7,405, 7,395 butterfly. This is a standard butterfly. We'll call it a B, right? The cost is going to be 50 cents. Sorry. It's going to be 10 cents. Let me go back one. So it's going to cost me $10, right? Put that trade on. And if it pins exactly at 7,400, I'm going to make $490, right? But the probability of that working out is to pinning exactly here is pretty slim, but it only cost me $10 per contract, right? So basically this is why we call it sort of a lotto play, right? These are probably 40 win rate, maybe 40%, probably I'd have to go back in and look, but probably about a 40% win rate. But when you do hit, it's, somewhere in obviously in between these two. Sometimes you can get a pretty good pin, but you're also, when I do these, I'm willing to risk, however many contracts I'm taking, I'm willing to risk the maximum amount, right? And the reason I like doing these on the SPX And if the SPX is too big for you, it shouldn't be for a trade like this. But if it is, you can also do the XSP. But the reason I like doing those is because they're cash settled. I don't worry about any kind of assignment on any of the spreads. And I just let that expire into the close, right? I can take it off for profit for sure, but I can also just let it expire into the close, no problem, right? Because XPS and XSP are cash settled securities. Now, if the difference is, so we look at the 7,400 and we're kind of far away from it. So our risk profile is really good, but the chance that it's coming all the way back up there, I don't know, probably pretty slim at the moment if I was going to put that on. But then let's go and look at something like, okay, let's say our absolute gamma level does move down into this put support and max pain area at 73.70. So if I go price out a 73.7, sorry, butterfly. I don't know why I said spread. So if I'm going to do that one and I'm going to buy a standard butterfly, right, a call butterfly, that one is going to cost me roughly 40 cents, right? So $40 per. So that one's, not terrible for 460 bucks, right? So that would be, a 10 wide, 73.70, 73.75, 73.65 butterfly. Now, if I wanted to push the risk profile, right, I could go a 20 wide instead. So then in this case, I could say, all right, well, I'm going to sell the 73.70s and I'm going to buy the 73.60 and the 73.80, right? Now that's a 20 wide. So my risk reward is different. And so if I go in and I price that one out, I just go 10 wide on that, 73.60, 73.80. Now it's going to cost me $1.50, right? So $150 to put that on, but my max profit now jumps to $8.50, right? So when we do that 20 wide, then our max profit on the total trade is 1,000, minus whatever you spent to get into it, right? And that's it. That's for one contract. So you can buy multiple contracts if you like, right? And so when you have this sort of outsized risk reward profile and there's ways to identify where the SPX in this case might close on the day, it's really advantageous to try to be able to predict where that's going to be and take a shot, right? And you don't have to risk a whole bunch. But if you're right, your reward is pretty high. Now, doing that with a standard butterfly is totally fine. I like to do it with an iron butterfly, which is essentially an iron condor at the same strike. So the butterfly trade we just talked about is you're selling two, in this case, calls, right, at the strike, and then you're buying the wings, right? So selling here, buying there. Right? That's a standard butterfly. Now, an iron butterfly, you are selling a call credit spread, right? And a put credit spread, and you're selling the same strike right here, right? So you're selling the 73.70s, basically one call, one put, right? Sorry, call and a put, and then you're buying the put and the call behind it on either side. So you're forming the same risk profile, right? You're forming the exact same risk profile. You're just doing it in a different way. Now, a lot of like Thinkorswim does not have a sell butterfly. You basically have to go sell a iron condor. If you don't know what an iron condor is, it's basically, let's say, I thought we would close somewhere in this range, but I wasn't quite sure. I would sell a call credit spread up here, and I would sell a put credit spread down here, and then any close in between the two would give me my max profit. But your risk profile is skewed the other direction in that. Right? Your max profit would be, it depends on how wide you want to make it, but your max profit's going to be like $100 and your max loss is going to be, $500. So it flips your max profit, but your probability of a win goes up because you have a wider gap. So if you're using a Thinkorswim, you set up an iron condor, right? Set up an iron condor like that, and then you move the strike prices into, you're selling the call and the put here, and then you're buying the ones behind it. And the reason we use 0 DTEs for this is because we want the theta decay to ramp up into the afternoon and get us, our max profit. Sometimes I'll let them expire because I think it's coming right into that level. Other times I'll take it off if if things go in the direction, but I'm not super confident that they're gonna hold there. Fog, SPX symbol on toss, if you're using active trader and the thinkorswim platform, is XPX. But if you are using the web application, I think it's XPXW. Someone please correct me if I'm wrong, but that's what I think it is. It's either that or $SPX, but I think it's XPXW. So for instance, yesterday's absolute gamma at 10:30, it's not on here anymore, obviously, because we're into a new day, was this same 7,400 strike, right? And so when we were up here somewhere, right? No, right. I put in, and there was a large open interest level here as well. And I said, I'm going to get a butterfly, a iron butterfly for that level, and I'm going to make it 10 wide, right? So I was at 7,400, and then we did 7,410 and 73.90, right? So that was the range I needed this to close in if I was going to let it expire, right? And I can't remember what I put it on for. It was pretty cheap. I think it was like 20. And if anybody took this with me, please jump in if you have the values. It was like, 20 for, a 980 potential if it pinned exactly. Now, I know somebody took that with me, and I'm going to use them as an example. I'm not going to get their name right. I should scroll back in chat and see. But I took that at 20 and was looking for a move down into here. And then of course we got that, right? We got this great move. And because, it was only, you get a credit for that. So you get, I got 980 in my account, and it starts getting better and better and better and better. As we get close to this 7,400, I was up, almost into, I was up $400 on that per contract at one point. Now, what one person did, there it is, Coach Bill. Thanks, Coach. Coach made 653% on it, because as this thing rolled from here to here and got really close to that level into the close of the day, right? All of a sudden he could buy that thing back. For you got 980, let's say, you can buy it back for 400, $4, right? You got 980, buy it back for $4, pocket this difference with a risk of only $20. That was $653. 653%. I'm sorry, not dollars, 653%. So, and he didn't let it expire till the end. Now, I did not do that. I was like, okay, I feel like this thing might expire all the way till the end, and I'm going to just watch it and see if it does, because I want to get, that max profit. I was feeling a little cocky, and I already had a pretty decent sniper day. So, losing $20 was not a massive loss, but I did lose out on great profits because, and this is why, I had the 7,400 strike. This was the sold strike, and 7,410 was the purchased strike. And obviously 7,390, but this one is not as important. So anywhere in here, right, would have given me some level of profit. Anything outside of that is max loss. Well, we came down. We looked like we were going to be good, and then boom, we get this little run up and we close outside the range. So I lost my $20 per contract, right? Which was totally fine, but I could have taken it off, for 600-700% had I closed it before it maybe bounced out. So that's kind of some of the risk there, but I was fine losing $20 per contract. That wasn't really a big deal, but I did lose out on some profit because I didn't swap it out. Just feeling a little my risk profile was a little outsized because I had already had a decent sniper day, but Bill smartly took it off for 653% and did what he should have done, right? Which was take those profits and go home. So these things can be a pretty fun way to take a kind of a low risk trade, as long as you're not going outsized, like taking, 30 contracts worth. If you can guess that level as accurately as possible. And I've found, we've tried to do it in DPL for many years. I'll take this because it looks like we might gravitate towards that. Let's say it's a round number, or, it's kind of where VWAP's coming into, and we're always kind of guessing, and granted, we hit sometimes, but increasing their probability by using gamma exposure levels really kind of changes the game. It's still a lotto trade, and it doesn't always close there. I have been keeping track of those trades, and I think also, like, historically, these work better. I'm looking it up real quick. Historically, these tend to work better on, I think it's Monday, Tuesday, and Wednesday, and not as well on Thursday, Friday. They work better on Mondays and Tuesdays. That's just sort of a historical data, right? And so if you like them, play them on Mondays and Tuesdays. Wednesdays and Fridays also work pretty well. Thursday seems to be the largest day of potential loser, but they're great and low cost ways to kind of play that 0 DTE trade into the close and use theta. So many of us buy calls and buy puts, and if we're doing a 0 DTE, we're buying calls and buying puts, and we stay in the trade for very long, longer than an hour, we can see that theta decay happen pretty rapidly. I don't know how many of you all play the snipers, but you know what I'm talking about, right? So to flip that script and use that theta decay to your advantage. Another thing that I like to do is we came down into this gap close. I actually played two things as I was coming on the mic. I played a standard call right up with the OCO order for 25 and 15% stop loss, and it took me out at that 25%. But then I also, because I felt we were coming into what could potentially be a low for the day, unless we get into like a trend down kind of day, I also did a put credit spread right here. And a put credit spread is a bullish play thing. And basically all this has to do, because I don't have a call credit spread above it, all this has to do is close above the 73.40 level, and I get max profit for that, right? And because I bought it at that level, it's a 5 wide, and I think I got it for 220, right, per contract. So that would be my max win if I let it expire all the way into the end of the day. So I like to use these plays that also use theta in a 0 DTE environment to your advantage, versus having it work against you in some of these quick buying calls and buying puts.